Hi, I'm Raoul Pal. I'm the co-founder of Real Vision and also the founder of Global Macro Investor. I want to talk about Bitcoin and cryptocurrency. It's the hottest thing this year. It's the big market play that many people have been watching. It's sucked in a whole number of people. Now, you've all got your own thoughts on Bitcoin. Is it a bubble? Is it going to change the world? How you think about these things. And it's very personal. I mean, I've changed my opinions over time. But I think one of the most important questions to ask is, Bitcoin, how the hell do you value it? And that's a question that I first addressed when I started looking at Bitcoin about 4 or 5 years ago, when I started to think, well, how do you have a valuation framework for it? And I thought, okay, it has some of the attributes of gold. There was some that was mined, some that hadn't been mined. There was a finite supply, and we kind of knew what that number was. And so what I did is I imputed the gold numbers and backed it out to Bitcoin and got to a valuation of about $1 million. That would be the gold equivalent. Now, that article went around the world. It got passed around Silicon Valley and became quite well known as the first attempt to value this thing. Now, I've changed some of my parameters, and I don't believe that that still stands because I had a number of reasons why it could be valued at that valuation. But now things have changed. So what I wanted to do is I want to bring a bunch of experts to try and think through this. Now, look, there are no right answers. Some of these you won't agree with. Some of these you'll really agree with. But we need to have some understanding of how to value assets. And if Bitcoin is an asset, which everyone's claiming it is, then we need to understand how to value it. Paul Brodsky, the author of Macro Allocation Newsletter, recently joined Pantera. Pantera are a multi-investment fund that invests in the digital currency space, blockchain space, and that whole area. I wanted to hear what Paul thinks about this. He keeps an open mind and tries to establish some way of looking at the valuation.
I think everything that I've done over the last 30, 35 years resulted in being able to take a look at this from a set of experience, but yet very fresh eyes. I think I was around, fortunately, for the advent of securitization as a mortgage-backed securities trader and derivative trader, and then the swaps market came into play, and then obviously the internet. I'm viewing this as the next really fundamental shift in the way securities are structured and priced, and capital is formed and distributed in the market. So maybe because I've had that experience in the past, it allowed me and some others to recognize that this is fundamentally different, that cryptocurrencies, digital assets, really are something new and a true step shift in the way we're going to form and price and distribute capital and invest. What we have is the manifestation of a thin protocol, which is the internet itself, value being taken by its users. And instead of a business that sits atop that thin protocol and extracts rent. Facebook, for example, will take out $40 billion a year by charging its users for content and then turn around and sell advertising to its users that are providing content. It's a wonderful business model. And who knows if Zuckerberg even invented it, but he's certainly taken very good advantage of it. The inventor of the internet didn't make a dime. Alternatively, what we have here with blockchain is the users extract value for themselves, and there's no rentier. It's a wonderfully efficient way to disintermediate a number of different businesses, from banking to gaming to file sharing. The way to value the broad crypto spectrum is to take a look on a discrete basis at the different applications and see what kind of share they're going to gain. Will they gain share in currency like Bitcoin versus gold and fiat? Will they gain share in gaming as a means of usage, and therefore the tokens will appreciate, and so on and so forth? When you take a look at file sharing, we all have excess capacity on our hard drives. It's very easy to go into an ecosystem and begin, for a distributed network can begin to compete with server farms like AWS and the cloud. Why not? You drive prices lower for sharing, dramatically lower in this case. And so there's an application and a token that represents that, and the token itself is integral to the application itself, which means that the users of the application, if you were to rent out space yourself for your hard drive, then you would be gaining tokens. We're capitalists, we'll forever be capitalists, but this is really a post-capitalist theory where gain is actually extracted by producers rather than rentiers. And it's very exciting. But I think value flows hand in hand with production. And the more production there is relative to the amount of activity, economic activity, the more value will accrue to these tokens. So on a very broad basis, we started out with the comparison of 200 billion, and much of that is in Bitcoin, the price of Bitcoin, which really, I think, at this stage of the game is a proxy for excitement about the whole field, about distributed networks and blockchain technology and digital assets. I think the more participation there is, the higher the valuation of the entire universe of crypto. And it's going to gain share from alternative forms of money, from various industries and sectors. And I think that's the best way to think about it.
Next, we're going to hear from Chris Burniske. Chris wrote the book Crypto Assets and is a partner at the VC firm Placeholder. Now, Chris looks at this differently than Paul did. He really wants to use the kind of more traditional valuation models. And I think it's a very interesting approach, something that I've certainly looked at. So let's look at how Chris will value this.
When I started in the industry, it was as a buy-side equity analyst. And to value different companies requires looking each year at what the projected revenue for that company will be, what the different margins will be for that company, and then valuing largely that company based on a multiple of, say, sales or on a multiple of earnings. I was working in the high-growth technology space, so we were mostly looking at price-to-sales ratios. And then, of course, there's more robust models if you're going to go through and do a full dividend discount model or something like that. But the key learnings from that process and the way in which I translated it into valuing crypto assets is to set up each year what the different flows of money or flows of value are going to look like for a crypto asset, and therefore the value necessary or the necessary stored value by that crypto asset in order to facilitate those money flows. So to make that more concrete, we can dive a bit into the methodology. Each year you can set up, so 2017, 2018, 2019, 2020, and well into the 2020s, you can set up these models using the equation of exchange. So the equation of exchange being MV equals PQ, where M is the monetary base, V is the velocity of that asset, which equals PQ. PQ, traditionally in monetarism, is the GDP of a company, where P represents the average price of a basket of goods and Q the quantity of the basket of goods. And so that basic idea is if a monetary base turns over at a certain velocity, that monetary base is used to sustain an economy of size PQ. And the way that translates to crypto assets is each one of these protocols, each one of these networks is largely a single good or couple of good economy of size PQ that has a native asset, a native unit of account that is facilitating that economy. And so to solve for the value that any crypto asset must store, requires us to set up that equation to solve for the monetary base M. Bitcoin is actually one of the harder crypto assets to value, and to explain why requires us to dig a little bit into the taxonomy of crypto assets and why I use the term crypto assets. So I think of crypto assets as having three verticals. So you have cryptocurrencies, crypto commodities, and crypto tokens. A cryptocurrency serves as a global medium of exchange, store of value, and unit of account. And Bitcoin is a cryptocurrency, right? So it falls in that vertical, as does Monero or Zcash or Litecoin and those assets. It is, particularly hard to value a cryptocurrency, and some people, like Professor Damodaran, would claim that you can't value a currency; you can only price it, right? And so that becomes much more contentious. The way I have been approaching valuing Bitcoin is quite similar to how I would approach valuing, Ethereum or Filecoin or Golem or any of these networks. It's just that the total addressable market that we are looking at in the case of Bitcoin can be much more varied and requires a more complex model, I would say, than something like looking at global cloud storage. Because as a currency, there are many, many, many different verticals that a currency can fill as a medium of exchange and also as a store of value. And so if I wanted to value Bitcoin, I would look at things like the remittances market, both C2C and B2B. Things like of course, the global store of value market, so looking at the gold market. Then, you start to get into, well, maybe this will be used for high velocity payments, micro payments, as second and third layer scaling comes in. So that starts to become very nuanced and detailed, as opposed to something like approaching the global cloud storage market, which it's much easier to chunk out.
Nick Colas of DATATREK Research, he's trying to approach it in a different way. It's again a little bit like the currency, but it's kind of in a more supply model. So I think we should listen to what Nick has to say, and then we'll have a much broader perspective from listening to all of our guests in some of the ways we can approach this.
The way I think about it is currencies anywhere in the world really have three values. They act as a scorecard, they act as a transactional reference, and they act as a store of value. And Bitcoin has really so far only been a store of value. It's still fairly difficult to use Bitcoin for transactions, so it's not really yet addressing the transactional needs of currencies. It does, however, do a reasonably good job so far of the store of value. So I would argue that it's a comparable situation to currencies, but only in the context of storing value. One of the hallmarks of investing and analysis is to look at comparable situations. In the equity markets, we look at comparable companies. I used to cover the auto industry, and so if you wanted to analyze Ford's valuation, you looked at it against General Motors or Daimler or Fiat, and you went around the world looking for comparable situations and then developed a point of view about relative valuation after that. And I think you can use that same analysis with Bitcoin. And the market that I look at is physical currency. So if you're looking at Bitcoin with roughly $120 billion of value, let's start looking around the world for comparable kinds of currencies. For example, $100 bills. We're all used to them, we've all seen them, but they are a market unto themselves that are based on supply and demand. The supply comes from the Federal Reserve, and demand comes from people that would like to have that currency in their portfolio. Because of the demand over the last decade, there's now over $1 trillion of $100 bills in the world today. And those are legitimate $100 bills. There's probably another $1 trillion of fake $100 bills because currencies do get forged. And as a result, just in the US dollar market, we're looking at probably $2 trillion of $100 bills. If you look at Europe, 100 to 500 euro notes, there's roughly 550 billion euro or $600 plus billion of those notes as well. So if you just add the euros and the dollars, two very, I think, similar assets to Bitcoin in terms of what they're used for, you end up with a market just for those two currencies of roughly $2.5 trillion to $3 trillion. And against that, you only have a Bitcoin market cap of 120 billion and a total global crypto market cap of roughly double that. So in the context of looking at where should Bitcoin be valued versus its near comp, I'd argue the near comp is physical currency. And as a result, Bitcoin still looks cheap because it's a small percentage of just the two major markets' physical currency outstanding. And that's one way I look at Bitcoin. And by that metric, it feels cheap. It's a venture capital type of investment, a venture capital type of trajectory. And venture capital works in one of two ways. It either works spectacularly well or it fails. And we all know that most venture capital fails. So we have to attach some probabilities to that as well. And that's why Bitcoin being only a fraction of total currency outstanding makes some sense, because there's a very good chance that cryptocurrencies, particularly this 1.0 version that we're seeing now, won't be what we eventually end up with. And so all of these currencies, Bitcoin, Ethereum, Litecoin, all the Bitcoin spinoffs, might end up going in the trash heap, but the eventual technology development will still be robust. There'll still be a lot of growth in cryptocurrencies generally. So I look at it as a very high risk, potentially high reward, venture capital style payoff investment versus something that can be put into a traditional asset class.
Right, time to bring on the favorite, Peter Brandt. Peter has been very active looking at cryptocurrencies and Bitcoin. He's been trading it, he's been understanding it, and he's been in a bunch of Twitter fights over it. The good thing about Peter, he's asset class agnostic. He doesn't care, it's what the chart says that matters. So I think it's a really good idea to see what Peter thinks about the Bitcoin market, because he's always got a great view.
I look at cryptocurrencies in the same way that I look at traditional commodity markets or forex markets, precious metals, crude oil. I'm a classical chartist and have been throughout my career as a trader dating back to the mid-1970s. And I just find cryptocurrencies such as Bitcoins, Ethereum, Litecoins, Bitcash, particularly Bitcoins, can be viewed and analyzed in the same way that all other markets. As a matter of fact, as a classical chartist, I'll make the case that Bitcoins is probably the single most reliable, best charting market in the world, exceeding any equities or foreign currency markets or whatever. It's a wonderful market to trade. It complies with the classical rules of charting that were laid out in the early 1930s by Richard W. Schabacher very, very well. We have seen the entire advance in Bitcoins dating back to inception, 2010, 2011, really comply with classical charting rules very well. And they've complied particularly well since really the public has turned their attention to cryptocurrencies in recent years. I go by the general trading rule that I always want to be long the strongest in a category when I'm long and short the weakest when I'm short. And of course, when you look at a lot of what I call the junk coins, they underperform relative to Bitcoins. And so it's the Bitcoins, while it's extremely volatile, oftentimes 10% daily ranges in value, nevertheless, it does have liquidity that many of the other coins don't have. And so Bitcoins in particular, for me, is just a wonderful market to trade, and I analyze it exactly the same way that I would analyze any other market that I might trade.
One of the things I think about with Bitcoin is it has some attributes of equity. It's kind of a share of the blockchain. So I spoke to Tom Lee from FUNDSTRAT Global Advisors, and I wanted him to use a bit of an equity framework. Let's ask Tom how he values Bitcoin.
That's a tough question to answer, but let me just sort of start with how we traditionally look at traditional equities. There's several ways to look at equities. One is compare equities to an underlying fundamental valuation. So for a company that's obviously using a discounted cash flow model with a terminal value, or even thinking about public comparables, if it's a takeout. When we look at a market broadly for equities, that is extended to looking at the market value of the enterprise relative to its market size. So for the stock market, the best metric is equity to GDP. And the third way is obviously to use a relative valuation approach, which is to value equities either against a risk-free rate plus premium or against equities versus credit. And that's, I think, a lot more common these days for folks to look at equities relative to credit. Now, to apply this to crypto, it's obviously a little more challenging for a couple of reasons. One is blockchain itself is structured differently than other traditional technology protocols. One of the features of it is that blockchain, because of the proof of work that's embedded within Bitcoin and currently within most of the other tokens, there's a payment made to those who are doing proof of work, which makes the protocol layer, or what you call the blockchain network itself, generating internal cash flow. So it's different than looking at a technology where applications are laid on top of that. But the simplest way we think to value these cryptocurrencies as a consequence is to think of this platform as an alternative medium. And I think one of the simple ways is to just look at it as an alternative digital currency or an alternative currency and a share of that market relative to the total currency market. A couple of approaches make some sense for Bitcoin. One is the idea that a transaction platform, which Bitcoin and these other blockchain technologies are trying to become transaction platforms, means that the value of the network should grow with the number of users. And there's an established sort of thesis that George Gilder started, which he says that the value of the network is equal to the square of the number of users. And a professor at MIT, Metcalf, actually essentially proved this out. So one way to value a network like Bitcoin is to look at the number of unique addresses and the transactions executed by each address. And if you use a log function for that, that has explained 94% of Bitcoin's move since 2013. Now, longer term, we think it makes more sense to look at this as a store of value concept. And in our approach, we look at Bitcoin capturing 5% of alternative currencies, which is today dominated by gold. And in 5 years, if Bitcoin captures 5% of that share of alternative currencies, each unit of Bitcoin is going to be worth roughly $25,000.
Okay, now we've got some context. We've got some ideas of how people value it, but let's cut to the chase. Where's this thing going over the next year? That's all we want to know.
We think Bitcoin is still actually surprisingly in the earliest stages of adoption. Before coming here, I just checked the wallet distribution, and today there's only 500,000 unique addresses that own $10,000 worth of Bitcoin, which means that while Bitcoin has a lot of visibility, the number of folks that actually own it in size is actually quite small. And we think that that's an opportunity. Assuming wallets grow, and of course, as you double the number of wallets, it actually increases by a factor of 2 the value of the network. We're pretty bullish on Bitcoin in 2018, and it's very likely that our $25,000 target by 2022 could be reached a lot sooner.
Well, Bitcoins are currently in what classical chartists call a parabolic advance. A parabolic advance is basically an advance that it's accelerating at an accelerating rate. And someone might look up the concept of the parabola on Google to more completely understand what a parabolic advance is. But the very nature of parabolic advance is the market is accelerating at an accelerating rate. Market target is 10,000. It has been for some time. But the nature of the parabola as a chart construction is that when it is violated, markets have severe declines. And so I think this parabola is probably running out of time to a certain degree, that at some point the lower boundary of the parabola will be violated and we'll see a severe decline in Bitcoins, perhaps to the magnitude of 50 or even 60% of its value. That there's a lot of latecomers, a lot of late buyers in this market that are going to ever regret getting involved in a market that they did not understand. And I think that's what we're seeing today, is a lot of people climbing aboard a train and they really don't understand the very nature of the market. They're buying it because it's going up. And so while Bitcoins have upside potential, and who knows what kind of upside potential over the next month, 3 months, maybe even 6 months, over the next year, we'll see a substantial correction in the Bitcoin market.
What's been very clear watching Bitcoin, particularly with the failed fork last week, where they decided not to go ahead with an upgrade to the software, and Bitcoin Cash came along and tried to steal a lot of thunder, is that it's clear there's a lot of money at stake in this space right now, and developers of alternative cryptocurrencies are going to come for Bitcoin ever more aggressively on the issue of scalability, on the issue of how much utility there is in the blockchain generally. So what we saw over the past 5-10 days is really just the first shot in what I think is going to be an ongoing, almost civil war in the cryptocurrency industry because the stakes have gotten so high. We're talking about $200 billion of total value across all cryptocurrencies. And there's going to be a fight to see who can hold on to or eventually push Bitcoin off of the number one spot. We saw a lot of that over the weekend, and I'm sure we're going to see more because the stakes are now high enough that people can dedicate 10, 20, $50 million to trying to create a new currency that will push Bitcoin off the top. And the question is going to be, is Bitcoin the MySpace of cryptocurrencies, the first mover that never really actually was able to sustain value? Or can it skip that kind of painful teething stage and become, from the start, the first and most preeminent cryptocurrency out there? So I see a lot more volatility. I see a lot more contention inside of the crypto space and people trying to push Bitcoin off the top spot. So it's going to be a very interesting year, and I'm still bullish on Bitcoin generally. But I think if you're uncomfortable with the volatility that we've seen in the past year, you're just going to see more of it in the next year.
Any outlook on the future price of Bitcoin really needs to take into account the supply side and the demand side. And the supply side is very predictable for Bitcoin, right? So we know with Bitcoin right now, its annual rate of supply inflation is roughly 4%. And that got cut in half in the summer of last year. And we know in the summer of 2020, that rate of supply inflation is going to get cut in half again to 2%. So we have this predictable rate of supply inflation going forward for the next 3 years. Now, if the demand of Bitcoin is increasing, right, at more than 4%, say annually, while the velocity of Bitcoin is staying constant, then that would imply that the price needs to rise in order to meet that demand, right? Because there's simply, at the margin of the bid and the ask of demand based on supply available, Bitcoin would have to rise in value in order to meet that demand at the given supply cadence. So any investigation that I'm going to do on the future price of Bitcoin takes into account, okay, what do I think the demand drivers are going to be? Why, what are the probabilities around those demand drivers, and then mashing that up against the supply.
I'm in the process now of talking about some of these issues that we've just been discussing with institutional investors of all sorts, with family offices, obviously high net worth individuals, endowments, foundations, all the way down the line. And they are just beginning to get this and internalize it and see it as a potential asset class. And so in 2018, my sense is that it's going to become more accepted. I have a feeling that in 2018, we're going to see a major Wall Street firm, bank or investment bank, probably investment bank, begin to custody Bitcoin. We're already seeing the CME announcing that there's going to be Bitcoin futures. I think it's going to become slowly more mainstream and then suddenly more mainstream, and people will have to be in. There's a general excitement about the whole space. Obviously, Bitcoin has run up. It's very challenging to look at a hockey stick graph of the Bitcoin price and say, well, gee, I got to get in. We don't do that as value investors. We tend to shy away from that kind of thing. But I'm a little more comfortable understanding that if I had originally funded Bill Gates for Microsoft and gave him $1 million and I watched the progression of his success as he built out Microsoft slowly as a VC, I would have been able to mark up the value of my investment fairly dramatically. What we're seeing in Bitcoin, I think, is a public manifestation of that marking up. I think while it looks crazy to see Bitcoin go from $200 to $7,500 as we sit today, it's still a $125 billion market cap, and the broader cryptocurrency market is only 200 billion or so. Again, in the big picture, it seems very small relative to the potential disruption it's going to take. And you can't put the toothpaste back in the tube. The technology's already there. The ecosystems can be built. There's another 3.5, 4 billion people in the world that don't have strong fiat currencies, that don't have strong central banks, that have social, economic, and political issues. And just from the standpoint of transferring money back and forth, it's a total disruptor to the banking system. And it seems to me it's already in place, and all we have now is a very low gross market cap that in 2018, I have a feeling will really appreciate. Whether it's Bitcoin or it's the top 15 or 20 cryptocurrencies and tokens. We have our own opinions on that at Pantera, and we're moving in that direction. But I think you're not supposed to just invest in one crypto like Bitcoin or Ethereum or, there's Ripple, there's others. Last week, we saw after the demise of the second hard fork, which I won't get into, but we saw a one-day appreciation of 40-odd% for Bitcoin Cash and a decline in Bitcoin. Well, okay. Well, you own them both, and you own 15 of the other best tokens tied to the most disruptive applications. And so that's what we're looking at, and we think there's never, I shouldn't say never, but it's rare to see an asymmetric return profile this much in your favor.
So the final question remains is, where do I see it going? Well, my view's contentious. I sold out early at 2000 and watched the price quadruple on me, but I got in very early too. So I did very well in the trade. But really, the things that I thought about originally about Bitcoin, the sacrosanct 21 million coins, I think with the forks, I feel that that's not really sacrosanct anymore. You can basically split the same chain repeatedly. That has to have dilutive effects. There's more and more of the same thing with a vague difference. Now, each one of those will incrementally take some demand away. So I think it's demand destructive over time. It's basically a dilution in different weights. It might be a rights issue. Some people think it's a dividend, but there's no free lunch here. You can't just keep inventing things that are all worth more. Or if not, we could all just do nothing else but just buy every one of these fork coins. So that issue is there. I also think that the world is moving away from using Bitcoin as the architecture for the financial system. From my discussions with VCs and people at the heart of the financial system and people at the cutting edge of the Bitcoin industry or the blockchain industry, they're all talking about blockchain and how private companies or groups of companies can make a distributed ledger amongst themselves and have a token that doesn't trade publicly, because it's of no use to all of the investment banks to have this token that goes up 1,000% in a year, falls 50% the next year. That's unusable for business. And I know we can hope and pray that the volatility dies down and we get some sort of smooth valuation of Bitcoin, but I think most of the big innovations are going to come elsewhere. They're going to come on blockchain technology, but without the use of most of the cryptocurrencies. So there's a number of reasons. I've written about this in the past and made some of this quite public, but I don't think Bitcoin is destined for the heights that I first thought. If anything, I think Bitcoin is more like Cisco was in 1999. If you remember, Cisco was the internet stock that everybody bought because it made the architecture, the infrastructure of the internet. So when you didn't understand what the internet was, you just bought Cisco. And Cisco had an enormous bull market, and it was a bubble. It never ever got back to the highs that it reached over that time. Bitcoin shares similar characteristics. It's the way to play blockchain and cryptocurrencies and those changes to the financial architecture. So if there's only one real way to play it, agreed, there are some of the other cryptocurrencies, but there's relatively few ways to play it. Everyone piles into one thing. You pile into one thing, you create a bubble. In the end, the valuation was never that which the market was pretending it was, and it will fall away over time. So I actually think Bitcoin will probably trade lower next year as opposed to higher. And when I say lower, significantly lower. So did we answer the question, what the hell is Bitcoin worth? I don't know if we did. We tried our hardest, we spoke to a bunch of experts, and we've got some ideas of how to do it. All I can say is good luck with your own valuation metrics. If you don't have a valuation metrics or an idea of fair value, all you're doing is trading, which is fine, but you have to be cautious.